Hi, I'm Brian Anderson from Annuity Straight Talk. And what we do is we optimize safe money allocations that work in the context of your entire financial portfolio, whether it be real estate, asset, securities-based investments, or whatever you have, okay? Today I'm going to talk about one of the most dynamic areas of safe money, and that is called secondary market annuities. That's what we call them, and they're technically structured settlements that come from a personal injury lawsuit. And what happens is the recipient of those payments gets a structured set of payments from an insurance company, usually backed by a very highly rated carrier, New York Life, Prudential, John Hancock, the kind of companies that you can't get anything from, anything decent if you walk in the front door. Okay. And what happens is if the person has it and they don't need it anymore and they can justify selling it, they will sell that on the secondary market. It creates a higher yield to you. We purchase those, resell them to you, and what you get a better deal. You get a cheaper income stream. Okay, the way they work the most popular way is in the immediate income area. Okay, so let's say you need $1,000 a month for retirement. Okay, if you go to any of the insurance companies, you talk about SPIAs, which are immediate annuities, or index annuities with income riders. Typically, to get $1,000 a month is going to cost you in the neighborhood of about $200,000. Plus or minus, it's going to depend on how old you are. Okay, if we go into the secondary market, we can get you $1,000 a month for probably $165,000 or $170,000. So that's a 15% savings. It's a lot cheaper. Which deal would you rather have? You want to spend $200,000 for it, or do you want to spend $170,000? The problem with the secondary market is that you don't have a lifetime contract. You'll typically, that $170,000 will give you $1,000 a month for 20 years. It costs less. The one drawback is that it's not lifetime. So if, let's say, you're 65 years old, you're going to have income till age 85. Now, everybody's different in how they want to plan. I've got some clients that swear that based on family history, they're never going to make it to 80. The secondary market would be perfect for them. I got some people that are dead set determined to live to 100. Okay, if they wanted to go into the secondary market and we've got income to 85, then we need to plan, do additional planning with those other assets to make sure that something's left at the end. So where this works perfectly for the individual who wants to get the biggest bang for their buck on an income stream or a future lump sum payment meant for a specific need, and then that's going to give them a lot of flexibility with their other assets to plan for the future. So another area is, we call them lump sums, where it's just a future one lump payment of money. Okay, this works really well for anybody who's got a set expense at some point in retirement, and it could be a longevity issue. Maybe you want to have a big bunch of money come walking in the door when you're 85 years old. Okay, if you put the extra $30,000 from left over after the income stream into a lump sum product that paid out in 20 years, you'd be looking at a check or in the neighborhood of about $100,000 is going to come back to you. So the two together would allow for additional planning past the age of 85. What you get with the combination of the lump sum and the income stream is you get a cheaper income stream plus more remainder in the end. You've got a lot more assets in the mid-80s than you would have otherwise. We have immediate income, we have lump sums that meet a certain need, and what's really popular with the lump sums is short-term money. If people just want to protect their money, we can typically exceed fixed annuity and bond rates by 0.5% or maybe up to 1% for similar maturity years. So people that want 3, 4, 5, 6 year lump sum payments, just a place to stack money, it would be comparable to a CD, but just a much higher interest rate. Those are very popular for people that just want to protect some money and let it grow at a reasonable pace and deal with it at some point in the future. One of the things that's more applicable to a lot of the annuity sales that happen today, we have a lot of people buying deferred income riders. Okay, if you want to put $100,000 into an annuity and let it sit for 10 years and then turn on an income stream that's going to last for the rest of your life, the typical person putting $100,000 in and waiting for 10 years is going to get about $10,000 per year for life. We do the same calculation with the deferred income stream. It's just a payment that you're buying from another individual. It's backed by a major carrier, and we look to exceed the amount of money you're going to get. The secondary market annuity in the same scenario, instead of paying $10,000 a year, it might pay something like $12,000 a year. And so we can't say that it's a blanket recommendation for everybody out there, but in the instances where it works, and if we can justify the numbers, it represents a powerful opportunity for you as the investor to save money on income streams, to get a higher rate than any other safe money asset, and you get the same guarantee from a great insurance company that you do with any other product. If you want to talk more about secondary market annuities, you know how to click on the calendar and set an appointment, or just give me a call, 800-438-5121, and I look forward to speaking with you. Thanks so much and have a great day.